Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to talk about choosing the right global index for your ETF so that you pick the right ETF for your strategy. And I'm mainly going to talk about the indexes from the FTSE company and the MSCI company. But first I want to thank my 51 subscribers to being already subscribed to my YouTube channel. So I cracked the 50 number, which makes me really happy. So yeah, that's why I say it now. Normally I only mention it at the end of my videos to please subscribe and hit that like button. But yeah, I really was happy this week that I cracked the 50 number. So I wanted to thank my subscribers, and with that being said, I'm going to continue with the video and talk about index investing. So I hope you know John Bogle, or Jack Bogle as he was sometimes called as well. Sadly, he passed away, but he made it clear that investing into an index is actually key for us normal investors because it's actually the only way to guarantee your fair share of stock market returns. He talks about it extensively in his two books, The Little Book of Common Sense Investing and Bogle on Mutual Funds. I really like the little book of Common Sense Investing. The the subtitle here is the slogan that I set here as well. And I really like the book because he makes his points for index investing in this book quite good. He he goes into it quite extensively. It reads like a train. The only thing that I don't agree on is that mutual funds are better than ETFs for investors, as he says that ETFs are way too easy to trade, and that also gives incentive to sell. And he's right in a way because you can short ETFs quite easily, which is for me as a small investor, of course, not great. I don't want people to short my stocks and certainly not my ETFs. So in that regard, he is right. But on the other hand, ETFs are really easy to trade. You can go onto your broker, look at what the price is, put in your buy order, and buy it at the price that you see on that time. While ETFs, the mutual funds, there you have to wait until the evening when they determine the price of the mutual fund, so you don't know it beforehand actually. You can make a wild guess, but yeah, you are always buying a little bit blind, and I don't like that about mutual funds. But John Bogle, the founder of Vanguard, a big advocate of low fees for mutual and ETF funds. So yeah, a great guy. Also on YouTube, you can check him out in different interviews. When you type in his name, interview with John Bogle, you will definitely have a few hits. Look at those videos. They are truly amazing. He's an inspirational guy, and yeah, I wish that he was still around, but sadly, yeah, he passed away. But how do you actually choose the right index to invest in? Well, that's the big question, of course. So, what you should know about your ETFs and your indexes you want to invest in is from where your ETFs are from, who makes the index for you, for your ETF, where, in which countries does the index invest, in which companies as well, and then another point, actually 2 points that are not that important, but it can matter to some of you. So most of the time, the ETFs, the indexes where they invest towards, are distributed according to the capitalization of the companies, but sometimes it can be that they are equally distributed. So when you look at the S&P 500 equal distribution ETF, there all 500 companies have a weighing of 0.2%. So in total that makes 100%, and you know that you invested your money equally distributed over the 500 companies of the S&P 500. Of course, now the capitalization is ETF is better off because the Magnificent Seven has outperformed the rest of the S&P 500 by a lot the past couple of years, especially Nvidia has done that. So what you choose, it's up to you, but at least you know you have the opportunity to choose between the capitalization type or the equal type when it is around. And then, of course, another thing, the ESG norms, whether or not the index that your ETF follows applies the environmental, the social, and the governance norms, yes or no. That's, of course, for some people really important and for others not. As you know, my opinion, I think it's a good incentive for the companies to improve, but for now it falls a bit short. And then, of course, as European investors, we like European ETFs because they have a better tax advantage for us, of course. And those are always called UCITS ETFs. And the UCITS, it stands for Undertakings for Collective Investments in Transferable Securities. And those are directives, and the directives are actually from the European Union, and it allows an undertaking to operate freely in the whole European Union on the basis of an authorization from one member state. So, for example, you have a lot of ETFs based in Ireland. So Ireland gives the authorization, and by doing so, the ETF is tradable in the rest of the European Union. The first version was made in the 1985, and that was called UCITS 1. Then you had the UCITS 2 that was made in the early 1990s. Then in 2001 you got the UCITS 3. Then you had the UCITS 4 and UCITS 5 in 2016. And now there are new proposals that are being discussed since 2021 for UCITS 6. And when you read about it, they are already talking about the UCITS 7 norms. So they say it's going to follow soon, but yeah, we first have to await UCITS 6. When they are around yet already, either and I made a mistake here, please let me know in the comments down below. And then we have to talk about the global providers of the indexes. So those are financial companies who license their indexes to index funds, and that can be the mutual or exchange traded funds. So as you know, I'm an advocate of ETFs, but John Bogle was a big advocate of mutual funds. And as a founder of Vanguard, he also found a way to make a subdivision of his mutual funds so that a part of their mutual funds was actually tradable as an exchange traded fund. So they have actually a special kind of ETF, but that would lead us too far to go into that. But you have three big companies. You have the FTSE Russell company, the MSCI company, and the S&P Dow Jones company. So S&P stands for Standard & Poor's, and of course you know the S&P 500. I already mentioned it before. And the FTSE and the MSCI we will talk about in the next few slides. Then you have the CRSP, the Center for Research in Security Prices, You have the Nasdaq. So the Nasdaq 100 comes from the National Association of Securities Dealers Automated Quotations. And then we have the stocks, really important here in Europe, of course, where you have the European stocks 600, the stocks 50. So you have a lot of indexes that track the European market. And the company is located in Switzerland, in Zug, and it's controlled totally by Deutsche Börse. So they bought out the SIX Group a few years ago. So they completely control it now. But it's still, yeah, the main building is still located in Switzerland. So I wanted to mention that for sure, living in Switzerland here. Then you also have Bloomberg and Morningstar that are making indexes. And then you have others like Citi and Selective, which are smaller than the rest, but they also make indexes, of course. And few others as well, but I can't mention them all, of course. So FTSE and MSCI, those are the two that I'm going to go more into depth into. So we have the FTSE Russell, which stands for the Financial Times Stock Exchange, and it's a joint venture between the Financial Times and the London Stock Exchange. And the first index was made on the 3rd of January of 1984, and it's the FTSE 100, and that one started at 1000 points on that day. And then we have the MSCI, and that's the Morgan Stanley Capital International Company. In 1986, Morgan Stanley licensed the rights to the indexes of Capital International, and Capital International actually started in 1968, and they made their first global equity indexes in 1969, and one of those was the MSCI World. So this one is coming up later on in the video as well, and that's the global stock market index that tracks the performance of around 1,500 large and mid-cap companies across 23 developed countries. And large and mid-cap is a keyword here, and also developed is a keyword here. And I'm going to go into depth into those yeah, descriptions later on. And you also have the MSCI EAFE, also started in 1969. And that's then Europe, Australasia, and Far East. So it's actually the MSCI World minus the USA and Canada. And as an investor, it's always interesting. So when you invested into the Nasdaq 100 or the S&P 500, and you started with that, and then you say, okay, they are a bit overheated, those markets, and Europe and Australasia didn't perform that well in the past 5 years. So I want to diversify into those regions as well. You can immediately go into the MSCI EAFE index. So look up ETFs that invest into that index and diversify your portfolio like that. Or you can go separate into Europe, you can go separate into Australasia. It's up to you, but at least now you know that those options exist. So I think it's really important that you know that. So let's talk about developed, emerging, or frontier markets. It's a split of countries into categories according to the development stage of their economies. And when we talk about developed countries, those are the most developed in terms of their economy and capital markets. And really important points are that the country must be of a high income. It must also include openness to foreign ownership, ease of capital movement, and efficiency of market institutions. And when you then look at emerging markets, there they almost are developed countries, but they don't meet all requirements for being called a developed market. And when you look at China, for instance, then It's more about the openness to foreign ownership, which is a problem there. So for the rest, China is a great economical powerhouse. So they didn't do that well the past 5-10 years, but I think in the future they will certainly pick up the pace again. And then frontier markets, those are a bit special. You don't hear about it often, and that's normal because they are too small to be tradable. So it doesn't mean that their economies are bad, it just means that they are too small to be tradable. And when you look at the world map, so thanks to Hacksource 596 on Wikipedia, I could show this graph because on Wikipedia they are of course free to use. And yeah, you see the 23 countries that are considered as developed according to the MSCI company. And when you compare that to the FTSE, there are 26 countries. So you have Poland, Luxembourg, and South Korea that are extra in the list of developed countries according to the FTSE. So when you invest into the FTSE index, all world, the developed world, I should say. It's a bit funny because I list up the different indexes later on, and now I make a mistake myself. But when you invest into the FTSE developed, there you invest into those 26 countries compared to the 23 of the MSCI. So there you don't have South Korea, and for instance, when South Korea is going to perform exceptionally well this year, for instance, then you are better off of buying the MSCI emergent market because it's considered the emergent market for the MSCI. But when you invest into the FTSE, it's better that you invest into the FTSE developed market there. Then large, mid, and small caps. Well, that's a division according to the market capitalization of the companies. So you have large caps which are bigger than 10 billion. You have mid caps where you have a value between 2 and 10 billion, and the small caps which are between 200 million and 2 billion. The value of 200 million is a bit arbitrary. It can be 250, it can be 300. Also for mid cap, it can fluctuate a bit, and it's not a strict line. So it is a general guideline that I put here. So you have to check every index for which company they include, yes or no, because it can be that the MSCI and the FTSE categorize the same company into a different capitalization category. So just so you know, it can happen. And how does this look into a table of a 7 by 7? So it's just 7 by 7. Here downstairs it's 7 by 7. So for the FTSE indexes and the MSCI indexes regarding investing into the developed or emerging market, or investing in the large and or mid and or small capitalization companies. Well, first off, we talk about the FTSE All World Index. So for the FTSE All World, it's developed and emerging markets together with the large and mid cap companies. And that's then the same as the MSCI ACWI. And the ACWI is the All Country World Index. And all, that's already a sign that it's about the developed and the emerging markets together. So the FTSE All World is the same as the MSCI ACWI. MSCWI. Then you have the global all cap, and it's actually the same as the all world or the ACWI, but it includes also the small caps. And for the MSCI, then IMI is added to the name, and that's the investable market index. So the all cap is equal to the IMI in the names of the FTSE ETFs and the MSCI ETFs. Then you have the FTSE Developed Index, and there you only invest into the developed market, just the same as the MSCI World. So it's a bit confusing, World and All World, but All is everything, and just World for MSCI means you only invest into the developed world. So don't forget, FTSE Developed Index is the same as the MSCI World Index, except of course, as I said, FTSE 26 countries, MSCI 23 countries. Then you have the FTSE Emerging Market Index, and so there it's emerging markets together with the large and the mid caps, and the MSCI it's Emerging Markets Index. And then the FTSE Emerging All Cap, there the small caps are included as well. And with that being said, I thank you for watching to this video. Please consider subscribing. Getting up to 100 is the next goal now. So if you would be so kind to subscribe if you like this kind of content, it would be very much appreciated. Also hitting that like button, it helps out the channel enormously, because then the videos get distributed to more people that like this kind of content. So thank you for watching, and see you on the next video on my YouTube channel. Bye!